$3 trillion private lending ship is sinking and investors are jumping out.
Private equity is obviously collapsing.
The $1.8 trillion industry of private credit is under pressure. Some investors are running for the exits.
Private equity, private credit is a mess.
A private equity investment is expected to lose about $5 billion on one software deal. But the company at the center of it is still operating. Medallia is set to receive fresh capital. At the same time, its lenders are preparing to take control. Meanwhile, the investors who bought Medallia are expected to walk away with nothing. That sounds like one failed deal, but it is also a warning about a much larger problem. Private equity depends on selling companies and returning cash. Yet, across the industry, that exit process is under pressure. Thousands of companies are still waiting to be sold. So Medallia is not only a story about $5 billion disappearing, it shows what can happen when private equity's exit machine stops working.
What we've seen over the course of the last really 36 months is an environment where it's been hard to both buy or sell in private equity.
What fails? Who takes the loss? And who ends up in control? First, the company and the investment are not the same thing. The lost $5 billion was not cash sitting inside Medallia. It was the value of the investor's ownership. Think of a house with a mortgage. If the house is sold, the bank gets paid first. Only then does the owner receive whatever is left. A buyout works in much the same way. Medallia owes money to lenders, so those lenders stand first in line. The private equity investors only own what remains after that debt is covered. When that remaining value falls to zero, the owners can be wiped out. Even then, the company can still have customers, employees, and useful products, and it can continue under new ownership. That explains how Medallia can survive. But it does not explain why so many private equity owners are struggling to find a normal way out. Private equity is built around an exit. A fund raises money from investors. Then, it adds borrowed money and buys a company. The plan is to improve the business, and then sell it a few years later. The sale repays the debt and returns cash to investors. That final step matters. Before a buyer pays, the fund's value is still an estimate, but a number written in a report cannot be spent. So investors need cash. And private equity firms also need those payouts to persuade investors to back the next fund. For years, cheap loans made the cycle easier. Buyers could borrow at low rates and pay high prices. Then, interest rates rose. As a result, the next buyer faced a much larger interest bill. A company bought at yesterday's price became harder to afford. So buyers offered less, but sellers resisted the lower price, and deals stalled. However, this does not mean nobody is selling anything. Exit value rose in 2025, helped by a small number of huge deals. But the recovery remained narrow. By mid-2026, Bain said it had stalled again, and deal flow looked roughly flat through July. Beneath the headlines, cash was still moving back to investors too slowly. That is where one failed software deal becomes an industry problem.
We've seen huge funds receive massive redemption requests that are unprecedented in the history of private credit markets.
A lot of the firms that had made a big push into the retail market have had to deal with these redemption requests in an amount that was unprecedented. And to preserve the value of the funds, they've had to limit, in many cases, the amount of money that investors could take out.
Private equity funds are still holding roughly 32,000 unsold companies. Together, they are valued at about $3.8 trillion. But this does not mean all of those companies are failing. It means many funds still cannot find buyers at the prices they want. And even when a company is sold, the process now takes around 7 years. And for 4 years in a row, investors have received very little cash back. Each year, the amount returned was less than 15% of the value still held in the funds. That is the longest stretch on record. In plain English, investors are getting back only a small share of the money still tied up each year.
becomes a chicken and an egg problem where if you're not selling assets or selling companies and returning money to investors, they're in turn going to have less money to give you for future deals. And so everything kind of grinds to a halt.
As a result, the delay creates a chain reaction. Investors waiting for old money have less room to back new funds. At the same time, managers face pressure to sell. But a lower sale price can turn an uncomfortable estimate into a permanent loss. So waiting avoids that moment. Yet it also leaves investors without cash while the company keeps paying interest on its debt. That is why every aging investment creates the same choice. Accept the lower price, keep waiting, or create another kind of exit. What can a manager do when selling would make the loss official? One answer is to move the company into another fund run by the same firm. This is called a continuation fund. The new fund buys the company from the old one. Then, some investors take cash. Others stay invested. Meanwhile, the private equity firm may remain in control. This can be a legitimate solution. A good company may need more time, but the same manager is involved on both sides of the sale. It wants a strong price for the old fund. At the same time, it also needs the new fund not to overpay. That conflict makes fair pricing and real investor choice essential. So more time can delay a difficult sale, but it cannot rebuild ownership value that is already gone. And when nothing remains for the owners, moving the company into a new fund changes nothing. At that point, the debt decides who controls the business. That is where Medallia shows what happens next.
You've got some concerns.
Yes, I have some concerns. I'm an investor in the world. I have a lot of concerns.
I've sensed frustration from the asset managers. You have too. I can feel it now. I've got to be honest with you. I can sense the frustration that you've got, I think, with some of the coverage over the past few months.
Thoma Bravo took Medallia private in 2021 in a deal valued at about $6.4 billion. The purchase came near the top of the software boom. At the time, prices were high, and loans were cheap. By 2026, Medallia was carrying roughly $3 billion of debt. So the deal depended on the company growing enough to support that burden. But its performance fell short of those expectations. At the same time, software values also fell. Together, those pressures squeezed the owner share towards zero. And the lenders were taking damage too. Some had already marked the Medallia loans below the amount owed. So the lender takeover is not a $5 billion prize. They are not receiving the owner's lost money. Instead, they are taking over a company that can no longer carry its old financial burden. So, under the agreement announced in June, Medallia's debt would be significantly reduced. At the same time, the company would receive $150 million of new capital. Then a group led by Blackstone, Apollo, and FSKKR would become the new owners. And the stake held by Thoma Bravo and its co-investors is expected to be wiped out.
Goldman Sachs and JP Morgan are offering hedge fund clients ways to bet against the private credit market. They've assembled baskets of listed companies with exposure to this space, including European financial institutions and alternative managers. Private credit market, of course, facing pressure.
Now, the opening contradiction has an answer. The $5 billion was the ownership value. So that value was destroyed, and it did not move intact into the lender's hands. Instead, the fund and its investors absorbed the failed investment. Meanwhile, the lenders accept a company with less debt and fresh capital. They may recover value if Medallia improves, but they may lose more if it does not. Even so, the business itself is expected to continue, and Thoma Bravo is larger than this one fund investment. The loss hurts that fund's returns and may make future fundraising harder. But one failed deal does not automatically erase the firm managing many other investments. Medallia reveals what happens when the exit never arrives. The old owners are wiped out, the debt is reduced, the lenders move into control, and the company keeps operating. But was this an isolated failure? Pluralsight suggests it is not. Vista Equity bought Pluralsight during the same cheap money boom. The software company carried more than $1 billion of private debt. Then, the business weakened. At the same time, interest costs rose, and the sponsor marked its ownership stake down to 0.
We're selling $1.4 billion worth of assets. We're going to redeem these investors. They're just going to be redeemed in chunks as we see fit. And as you said at the beginning of the episode, they closed the fund down. This has sort of accelerated the feeling of panic.
In 2024, the lenders took full control. They cut roughly $1.3 billion of debt, and they also supplied fresh capital. So Pluralsight kept operating. But the lenders did not receive an easy reward. Instead, they exchanged a promise of repayment for the burden of ownership. Now they had to fund the business, improve it, and eventually find another exit. So the same pattern had happened again. Equity disappeared, debt became ownership, and the company continued. So which firms have enough money and time to take over companies like these? The Medallia lender group points to the answer. Blackstone, Apollo, and FSKKR are not built around one loan or one fund. Instead, large platforms manage different pools of money for different jobs. One pool can make the loan, another can provide new capital. Meanwhile, the lender group can negotiate the restructuring. Then it can take ownership and wait for another chance to sell. Blackstone alone manages more than $1.3 trillion. But that scale does not make it immune to loss. Some Medallia loans had already been marked down, and Pluralsight's lenders had to cut debt and put in more money. So ownership can preserve a viable company, but it can also leave the new owners carrying years of work and uncertainty. Even then, this does not prove that every continuation deal is abusive. Moving a strong company can give investors cash and give the business more time. And 2 software restructurings do not prove that the entire private equity industry is collapsing. So the more defensible conclusion is narrower. Stress does not hit every layer equally. A company can survive while its owners are wiped out. A fund can lose an investment while the firm managing it continues. Lenders can suffer losses and still become the owners. And the largest platforms can use more capital and more time to remain involved after weaker ownership structures fail. So the deepest pockets do not escape the damage, but they may emerge with more control.
Private equity still manages to run companies into the ground. About 20% of public companies taken private by private equity go bankrupt in their first 10 years, compared to just 2% otherwise.
So, what happens when private equity's exit machine stops working? Not one clean collapse. Instead, funds hold companies longer, investors wait for cash, and managers create new structures to buy time. But when that time runs out, the owner's stake can be erased. Then debt is reduced. Lenders become owners. Meanwhile, the company may continue under a new financial structure, and the larger platform can survive beyond the failed investment. Medallia made that chain visible, and Pluralsight showed it can repeat. So the traditional exit model is under pressure, but private equity does not fail as one single object. Instead, different layers break at different times. And when exits disappear, control can move toward the firms with the most capital and the most time to wait.